G'day and welcome to this week's video. This week we're going to have a bit of a discussion around a recent investment seminar that came to our small town and which could lead into a bit of a rant. 20 years ago when I first went into this industry, there was property spruikers that turned up to our small town of Horsham talking about the benefits of property, and obviously 20 years later a lot of local people got phone calls saying they've won tickets to a session, and in that session they'll learn all these strategies around wealth creation, and also they'll get themselves a free computer tablet as well. So lots of incentives to go. I looked up the website and definitely property spruikers again, from Queensland again and the Gold Coast, where they seem to come out of a lot. And I was keen to head along to make sure and understand whether the story had changed from 20 years to now. Now, in brief, no, the story has not changed. What they're trying to do, they've got a one-goal strategy here that's a one-size-fits-all, and that is to sell you a property. It's extremely well presented. The presenter is very, very slick in the way they handle it, and it's extremely well structured. So they're treating many emotional, issues around, not failing financially in retirement. So of course, no one wants to be a loser. So very well structured, and then also selling the bucket list of what retirement might look like for someone. So very well put together, well presented, far better presenter than myself. And it's all about really scaring and then inspiring people to take action. Now, of course, the one goal is only ever just to sell you a property, and there's probably a couple of things that really annoy me around what they're doing. And one is that they're essentially saying that every 7 to 10 years that property will double. Now, all the examples that the guy put together as people bought hypothetically bought their first, their second, their third, and up to their sixth investment property, they're essentially saying that it just will double every 7 years was the figure he ended up using for the examples. So it made the figures look, of course, phenomenal. And that is a real contrast to what I've seen with the clients that I deal with that have been sold properties via a seminar or through their accountant or their financial advisor, that these properties, for the most part, if they've held them for the last 7 to 10 years, have really not budged. Now, I do understand there are markets within markets, and some people have made really good money in certain areas. And that depends on the type of asset, where it is. There's lots of factors that go into valuing an asset and what will make it grow. But for the most part, what I see in these type of larger developments where a small block of land can have multiple stories and they sell these apartments, there is minimal growth. And it's probably it will be and is the biggest risky area for people to invest into if they choose to go down the property path. So the fact that they're trying to say that it will double every 7 years is a lie, and it's wrong. We just don't physically see this. The other one that annoys me is the fact the way when they're comparing property against the share market, and essentially he didn't bag the share market at all. He said that both will double every 7 to 10 years, but the reason that you'll go and buy property before you buy a listed stock, a business on the stock exchange, is because you don't get any decent deductions when buying a business on the stock exchange. But when you own a property, you get all of these deductions, and because you want to create meaningful wealth, life-changing wealth, you're going to take on a lot of debt to do that. So the debt means you're paying interest, you're paying rates, you're paying insurance, you're paying maintenance costs, you're paying all these extra things, and then you get the added benefit of further depreciation, which means that increases your deductibility on an ongoing basis. So essentially what they're telling us is that the more money, more deductions you have, the more money expenses you have going out, the more money you'll save. Now let me clarify this, that when we've got a tax deduction, and that will reduce our taxable income. If you spend $1 and it is only going to save you 34 cents on the dollar, or whatever your marginal tax rate is. So I would prefer not to lose money and spend money on all these different items to save 30 cents on the dollar. I'd prefer to pay the tax, reduce tax where we can, utilising superannuation and smart purchases that you need, and then invest the rest. But they're essentially saying that it's fine to lose money on an ongoing basis from a tax deductibility point of view, but I can only say that the only way that this works is the value of the asset continues to go up each and every year. And that hasn't been the case for many people. So I find that very frustrating. The risk people are taking on, very high levels of debt, $400,000 to $500,000 with the figures he was quoting. On top of that, it's one asset class. So there is no diversification. What if it all goes wrong? What if you have to sell? What if multiple people have to sell at the same time? Again, supply and demand issues. So a little bit of a rant. What I would suggest that people please seek independent advice from your accountant, from your financial advisor. Now, these guys stipulated during the seminar that they've got their in-house accountants, lawyers, financial advisors, accountants, all these people that I think that are in on the game and are not going to give you a balanced, impartial view. So by all means, go to these things like I just did because I was curious to know what's happening, but please get some independent advice from someone that is not within the system, not within the business, and is not conflicted. So I hope that's a help. It was a bit of a rant, but look, people, I've seen it before. There's high risk with this, huge opportunity cost, and it really does worry me. It's not a fair go on the average person. Thank you very much for listening. Please give us a thumbs up. If you like, subscribe to the channel if you haven't already done so. For those that have, thanks very much for supporting us, and we'll catch you next week.